Hi, I'm Mark Crescano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today is our favorite day, the Primary Vision Frac Spread Count, where we get to go over what's happening in the US, what kind of activity have we seen, and then today we're going to do a little bit of a recap of some of the things that we were talking about in the economy show and in the EIA show, so you can go back and watch those for more depth and just for things that we think are very interesting and should be looked at for the future, or at least over the next few months, as we see yields starting to pick up, inflation rearing its ugly little head. So we just want to go through some of those different important factors. But first, obviously, the Primary Vision Frac Spread Count coming in at 182. So we went from 165 to 182. We're up by 17. And just to kind of give you an idea of what that is, we had some increases in some of the smaller basins, and for those that got my report this morning, that was what we were seeing, is that some of the smaller basins, now that we've seen the pricing get a lot better, we see a continued strength in the NGL space. More naphtha cargoes are being exported from the U.S., so the liquids remains fairly robust, is really supporting that additional activity. All the residual from the Texas blackout is essentially gone. There might, right now there might be one or two spreads, but the growth has outpaced. Even if those are still down, we're still seeing that activity starting to come up. And it's a mixture of obviously just pricing in general, but also there's a certain amount of seasonality. And as I went through in the report in a bit more detail, typically we start to see that, the middle of March as we go through and go into pretty much July for the most part is when we see that pretty steady increase, once we start to average it out. And it makes sense, spring, summer, makes a little bit easier to start getting there. And obviously companies have that CapEx to spend on the front end. So obviously the other exciting thing that we can see is the Permian is now back over, or I should say is at 100. So we're back to triple digits, but now that we've started to see some of this increase, so just looking at this, 3-month chart, you can see that big drop from the weather, that pretty steady decline, and now we're back to the growth trajectory. Now we're gonna pause for a minute because we think there's gonna be a little bit of digestion, making sure that everything is there, things are operating, because you don't want to run too fast. So we'll start to see increases, or I should say we'll continue to see increases. It's just the delta is going to be much smaller. A lot of the low-hanging fruit has now started to come back, and now there's going to be a bit more of a measured move, which if you look at rig counts, we're starting to see that, where we actually had a small decline, starting to kind of level off. We still think there's going to be an additional activity. It's just not going to be on the same level when you look of, going from 140, 165, 182. Now that we've caught up, because before the weather impacts, we were at 175. We're now above that. So we're kind of back along those lines. Now, there are big storms that are coming through parts of Colorado. That will impact some of the spreads, but again, that's not going to be like Texas going down, where you're talking about the lion's share of U.S. activity. Instead, that'll most likely be something on a much smaller scale. And then just to put it into comparison to 2021, you can see obviously when COVID lockdowns really started to impact, but the growth is going to remain fairly steady as we come into the April months. Now, when do we get over 200 is going to be a little bit longer. It's something that is most likely going to be more of an April event, as long as we continue to see pricing remain at this level. And at 200, again, we're at, let's call it between 10.9 and 11 million. We'll start to see some growth, but it's going to be really hard to see a big jump to any, like, let's just say 12 million or a million barrel a day increase, just because we don't have that kind of capacity available at the moment. We don't have the same type of push, if you will, to get to those levels. So we're thinking as we start to approach that 200 into the 230 spreads, 11.3 million barrels a day is doable and sustainable, but really not back to those growth levels. Now, just to kind of pick everything up as to what is happening with the Bureau of Land Management, when you look at the approval of drilling permits, we're starting to see that pick back up. Continental had a lawsuit out there because they were saying that they were dragging their feet. Those got approved, so the lawsuit was retracted. and we're starting to see a little bit more momentum. And the commentary is it's more about strengthening the review process and not stopping. So this is just going to be something to watch as we go through the next few months to see how much of the acceleration is. But it's also important to see how far behind we are from 2020 to 2021. Now, these are just new permits, the ones that are currently available. Those can still be drilled, but just giving you an idea of where things are and how we are starting to see things pick up. Now, we keep getting some new updates. Some of the refinery outages are starting to reverse, so that's going to help pull some additional crude through the system. It's going to be a matter of when are they recognized, because it's going to be different in terms of when the EIA recognizes it on, is it going to be Friday or is it going to be Monday or Tuesday? That'll shift what week that this is actually going to be reported in. But net, we're starting to see those reversals. And remember, back when this first happened, we had said that about 5.5 million went down, and then there was about 2 million that was going to take about 4 weeks. We're coming up to the 3-week mark. That's now been reversed down to about 1.5, and we should get another big piece of that. Now, what have we seen because of the reduction in refiners? It's gasoline. So gasoline has been pulled through the market, which is always going to reverse and cause something else. So right now, the number of tankers seen coming from Europe into Pad 1 and Pad 3 is at May 2018 highs. So what does that mean on barrels per day? So global imports of gasoline blending components into Pad 1 and 3 more than doubled to 572,000 barrels a day in the week ending March 7th, with higher volume expected coming this week, bleeding into next week, of 802,000 barrels a day. At the end of the week, finishing March 7th, there were 30 medium range or MR tankers carrying gasoline blending components from Europe. So we're getting that surge back in. And now, as we talked about in the EIA show, March, we typically start to see an increase in gasoline demand. This is normal. The question is, how far below the last 4 years are we? And we're still tracking, we're increasing, but it's at a lower rate. So we want to see where the shift is. And the reduction is caused by the separation between weekend and weekday activity. Weekend activity is only 5%, 7% below historics, where weekday activity is still 30 to 40% down because work from home, people still not going to the office. So when you start to see that backdrop, because we're thinking that weekday activity will accelerate and be above that year over year, but we still remain concerned on the weekday activity, which is going to be the thing to watch. Now, on the other side, when we start looking at what is moving into the system, we look at what's happening with China. And we're starting to see another small increase in tankers flagging China coming off of the 10-week low. And that's putting us at about 105 off of the 99 we saw last week. Again, these are things that we're going to continue to look at and really kind of talk about with pretty much everything steady coming into the U.S., South Korea in general. So those are things to watch. Now, when we look at what OPEC has said, because this is going to look at some of those OPEC commentary. So world oil demand, they took down the first half. You can see that they've revised it lower, and they've really weighted that towards the back end. Now, the question is always going to be timing on when a lot of this stuff comes through, because India has seen an increase in cases. They've actually increased their stringency index, so they've leveled more restrictions on movements in specific provinces. And then Italy is going into another lockdown, and we've seen France and Germany also extend. So now, right at this point, Brazil is in a bad spot right now, and those are going to be things to watch in terms of some of our exports, because we export into a lot of these areas, and that's just going to be how quickly do we get past this? How quickly is the vaccine rolled out? And right now, the U.S. is continuing on the right trend. And in the past, we have followed Italy by we've been about 2 weeks behind them. So we're hoping to see that has disconnected, given that we've had obviously that limited international travel. But all of that is going to be important as to when do we start to get back to some sort of normalcy? Is it Q2? Is it Q3? Or do we get a recovery that starts in Q3, but the pace is going to be slower, given some of the restrictions that we're seeing in terms of just inflation and price in general, which we'll talk about again when we look at India. So when we're thinking about pace of just that physical demand, Angola still hasn't sold 10 cargoes of the 38 that it plans to export next month, and it's much slower than normal, which is a bigger problem as we expect to see May coming out in the next week. Now, Urals in Northwest Europe just sold at the lowest price in 11 months. It had bounced, as we had said, to 185. It's now back down to 245. So we continue to see that pressure coming into the market as differentials continue to struggle on the physical side. Again, showing that bifurcation between what is the physical market doing and saying versus what is the paper market saying. Now, when we look at supply, it's always important to look at, well, what is happening? Where are things growing? And here you can see the production in general continues to shift up when we start looking at some of the non-OPEC components of what is actually happening in the general market. So when we start looking at movements, you can see that there's an expectation for the U.S., as we've already talked about, some of those increases, the revisions have moved higher just based on what we've seen coming out of Russia and some of the other nations. Now, it's also going to be important to highlight what is going on in general when we start looking at Saudi Arabia, when we start looking at some of these other entities, because Saudi Arabia did decrease their production by 637,000 barrels, but I'm sorry, not Saudi Arabia. OPEC in general reduced production last month by 637,000 barrels, but OPEC plus exports increased 665,000 barrels in February. So we had a decline, but we had a net increase on exports, which is why we always talk about the importance of looking at what is happening with the production market, what is happening with the export market. Now, these are the different the separations that we continue to see. Just looking at what is happening in general, the market is currently not so undersupplied, but could improve with the rollout of vaccines. European imports of clean products from the Middle East has accelerated, and we'll talk about that in a minute when we look at some of the levels that we've seen in general. But Europe's diesel margin dropped to its lowest level since November, and this is just because we've kind of seen the end, or at least the tail end, of exports from Europe into the U.S. markets, which is going to start to pare back a bit. Now, when we look at what has happened in general, so we'll do a deeper dive on the EIA show next week, but we've had a net increase in Singapore across the board with totals pushing back towards all-time highs, middle distillate staying at all-time highs, and then light distillate or gasoline continuing to drive higher as we see a reduction in demand throughout most of Asia. Now, on the positive side, when you look at what's happening in Europe, you can see that there was a pretty healthy decline in gas oil and naphtha. The decline in naphtha is actually accelerating some of our exports from the U.S. into Europe. And then that's why, if you look at gas oil, that's why we see some of this residual now starting to open back up, and some of this Asian cargo starting to come back into the European markets. The problem is gasoline. So gasoline, as we've been saying, gasoline exports have been very large. They're now hitting not only just the U.S., but the Caribbean and Latin America, but yet they still have increases in storage. And this is really just a function of how low demand is and how demand is continuing to shift down in the European theater. Now, when we look at India, you can see that Indian demand was down year over year. Demand was 17.2 million tons in February versus 18.1 million the same month last year. To be clear, last year was a leap year, so there was one extra day of selling. So once you start backing that out, it isn't as bad as some of the official numbers are coming out. So unadjusted diesel usage was down 8.5%, while gasoline demand was down 3%. It's actually a little bit better than that, where diesel demand was only down about 5.3% and gasoline demand was only down about 0.3%. Still the wrong direction, especially now that we've had some renewals in restrictive movements. So again, that's going to be a problem, but diesel remains the focal point because that's really the bellwether for economic activity, and that continues to be under pressure. As you can see here, we had obviously that nice bounce off of August, but now as we start going through it, you continue to see how we've been fairly flattish with really no drive to the upside. over the near term, and obviously pricing is not going to help. So this is just going back to 2010, where you can see retail gasoline and retail diesel prices are at all-time highs. And this is, again, weighing on some of the issues in general. India has now just gone out and purchased about 5 million barrels from West Africa. So we'll start to see some of that additional capacity absorbed. But again, China remains the biggest problem in general when we start looking at what is happening. And then when we start looking at Russia, production rose to about 10.174 million barrels a day through the first week in March. The nation pumped an average of 1.388 million tons a day of crude and condensate from March 1st to March 11th. And that equates to daily production that we just described, which is about 79,000 barrels a day above the February levels. So they continue to move into it as they see opportunity in Asia. But as we talked about in the Northwest Europe, euros are trading at 11-month lows, which is going to put pressure on U.S. exports and is going to kind of shift where some of these demand numbers go. The problem is, as well, China continues to see an increase in storage levels. So this is looking at Shandong. Shandong is now back to the highs for 2021. And just based on the pace of ships showing up, low demand, you can see that we're going to continue to see some of these increases in just oil storage in general, because when we look across the commodity complex within China, we're seeing that a lot of these commodities are either at or near all-time highs, which is going to keep that pressure on just general commodity pricing as we go into the next few weeks. This is looking at fuel oil. So fuel oil is back to the highs for 2021 and trending in the wrong direction based on where they should be trending. Because if you look here, when you look at the average, typically you're at a peak until you start getting into coming out of Lunar New Year. And then as you come out of Lunar New Year, you see that movement down from, let's call it the end of February through to the beginning of April. Instead, we're moving in the wrong direction as activity still remains slack in the Chinese and Indian markets. And obviously, and we'll talk about this in the econ show, but inflation perked up again in India, which is going to be a problem and something to watch. It's still within the range, but that could be a bigger headwind as we continue to see rates moving up in the U.S. And then China is seeing a big increase in PPI, which they're also going to have to, or going to have a choice of either subsidize or export. And just based on we did a show on it on Thursday, looking at the 5-year plan. What did the Chinese Communist Congress talk about? And debt still remains a huge problem, which is why they're going to be limited to the amount of stimulus they can push in. And this is just going to look at some of those numbers. So China copper smelter inventories, you can see that going back to 2015, copper in storage or in inventories is at all-time highs. Then when we think about moving away from copper and going to rebar, China rebar is at near all-time highs. The only time it was higher was when they went into a lockdown in the beginning of 2020. So we're back to essentially COVID-type levels that were caused by them doing absolutely nothing. Now, as we've talked about, rebar facilities have been shut down. Steel facilities have shut down because margins went negative. And now you're starting to see why margins were negative. Where it's not only the fact that iron ore prices, coal prices spiked on one side, but you also had falling demand on the other, which is going to limit the amount of activity. And now iron ore, it's still at a high as it's well back above where we were at the end of 19, but it's not at the levels that we saw in 2018. But you could see as we go back to 2006, it's still at the upper end of that range in general. And the reason why this remains concerning, because when you think about stimulus, every country continues to talk about it. We discussed it in segments 1 and 2 of the econ show, but just to provide an update, because some of the bonds have been under pressure following the auction. You can see that the 10-year Treasury inflation protected is now spiking back up to the highs as we get just the inflation rate and just the generic government 10-year continuing to drift higher. And when we think about that, because we want to look at the 10-year and the 30-year, you can see that they're all moving in the direction with the 30-year actually breaking out to near-term highs, going back to levels that we haven't seen since the beginning of 2020. Same can be said for the 10-year, but it's just we're continuing to get this steepener. And what is the steepener? Well, let's look at longer dated. So here you can see the 30-year back to the highs that we had at that spike in the middle of February. But the problem is now we're getting this pretty steady move up, and the pressure continues to mount as it looks like a lot of international countries, or in general, we're getting some of this pressure from the outset. And then when we look at the overnight repo, you can see it's negative again, which is pushing banks to go to the Fed and take a fixed rate. Now, the reason why this all matters is because when we look at U.S. debt margin debt levels, you can see that they've exploded to all-time highs. And what does that mean? It means that, a lot of these trading organizations, if they give margin, they just pass through the cost. So as the cost goes up by looking at the 30-year, the 10-year, as that cost goes up, margin costs go up. And then you start getting margin calls, and then your ability to borrow on margin or the margin available goes down. And that's when we're going to start to see some of the pressure come out of this market. And then why is inflation, all these things so important when we talk about PPI and whatnot? It's because, well, the continuing claims continue to move up when we start factoring in regular benefits and all of the extended benefits. So yes, there was a decline in regular benefits, but there was an actual increase in the extended benefits, the pandemic emergency benefits. And just looking at February 20th versus February 13th, we went from 18 million to 20.1, and it was all driven based on the pandemic unemployment assistance and the extended benefits, which continue to be the additional side, which is just because people are still struggling finding jobs. Again, coming to wage compression, joblessness, as inflation and prices continue to go up, because I know personally my monthly expenses are up at least 5 to 7% just based on daily life, and in terms of everything from gasoline to food to just, do your own calculations, because it's a fun exercise to see where you sit. And the problem is that's not stopping, because when we look at PPI, U.S. producer pricing, and when we look at PPI around the world, not just in the U.S., they continue to trend higher. And you can see that they were getting back to those 2018 levels with little to stop that in terms of the movements, just based on some residual logistical issues, supply chain problems. And we do have some recovery in the U.S., which is going to increase that demand and continue to push up those prices, as we talked about in the Econ show in segments 1, 2, and 3. So these are things that are going to keep that inflation moving in the upward direction. And then if you look back to where a lot of this originates, into China and some of these others, their PPIs are going up. And then on the other side, imports are falling in some of these key areas like Japan, China, and Germany, which really rely on exports. So as imports fall, manufacturing is coming under a little bit of pressure. That means that exports will also come under pressure, and these are exporting nations. So as those exports come under pressure, that just points to more economic weakness. The GDP is going to be pulled down. China has already said, a lot of the market was expecting 8.5% or better on their target. Instead, they came in at above 6%, which is a bit, was concerning. And so far, the market has kind of ignored some of that. But when you look at their level of commodities and storage, the amount of pressure coming in, the amount of inflation, the amount of pricing, it's going to be difficult. And now we just had another announcement of sanctions going against, or the FCC saying that it's a means of national security, looking at not using the Chinese companies. So on the telecommunications side, so we're seeing more and more pressure ratchet up, as we've talked about, written about, and we discussed again in segment 5. So there was a lot to cover, a lot to summarize, but that's kind of the long and short of it. Hopefully everyone has a great weekend, and next week we always have our exciting shows of the EIA economy and Frac Spread Count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.